Hi friends, this is Vinay. Welcome back to Simplifying Stock Market. Today in this video, let us learn about return on equity, return on assets and return on capital employed. Return on equity. This ratio indicates the returns being made by shareholders on initial investment in the company. Let us say there is a company A and it spends money to buy a machine worth 10,000 rupees and earns a net profit of 2,000 rupees in an year on it. Therefore, return on equity is equal to net profit multiplied by 100 divided by shareholders' equity. That is 2,000 rupees into 100 divided by 10,000, which comes out to be 20%. Let us see another case. Say there is a company A and it spends money to buy a machine worth 10,000 rupees wherein it obtains a debt of 2,000 rupees for it. So here shareholders equity is 8,000 rupees and the debt is 2,000 rupees. Therefore, return on equity is equal to net profit multiplied by 100 divided by shareholders equity. That is 2,000 multiplied by 100 divided by 8,000, which comes out to be 25%. So here return on equity is 25%. Therefore, high return on equity is a positive indicator, but increase in return on equity due to increase in debt of a company is not a good sign. If the debt is high, it gets risky to run the business and it is a caution for the investor. While comparing the return on equity of a company with that of another company belonging to the same sector, one must also have a check on the debt before investing. Return on assets. Return on assets. This ratio indicates the ability of a company in using its assets to make profits. Assets are sourced by equity and debt. Assets are of two types, current assets and non-current assets. Those assets from which returns are to be realized within an year, that is within the accounting year, those are current assets. And those assets that from which returns are to be realized for more than an year, that is like long-term investments of a company, those are all categorized under non-current assets. And liabilities are also of two types, current liabilities and non-current liabilities. Those short-term liabilities that are to be paid off within an year are current liabilities, and those liabilities that can be paid off beyond an year are non-current liabilities. Return on assets is equal to profit after tax plus interest divided by total assets. Here interest is considered as 1 minus tax rate. Return on assets is calculated using also another formula, that is profit before interest and tax multiplied by 100 and divided by total assets. Therefore, companies with better return on assets indicate better utilization of its assets in making profits. Therefore, an investor must have to compare return on assets of a company to another company belonging to the same sector before investing. Return on capital employed. This ratio indicates profitability of a company from both equity and debt. Return on capital employed is equal to profit before interest and tax multiplied by 100 and divided by total capital employed. Return on capital employed must be greater than cost on capital. I mean, it must be greater than the interest on capital employed. If profits made by the company are equal to the interest paid on debt, then it will be difficult for the business to run to meet the operating expenses. Therefore, higher return on capital employed indicates that company is doing better in making profits. Therefore, an investor must have to compare return on capital employed of a company to that of another company belonging to the same sector before investing. That's all in this video, and we shall learn about leverage ratios in the next video. Thanks for watching. Goodbye.